Hey everybody, my name is Justin. Today I want to talk about Huntington Ingalls. They had some big news that they announced today. We saw a small sell-off in today's market. So I want to talk about Phil Town, and is he going to sell out of his position based on the news that we heard today? Huntington Ingalls is one of my largest positions in my portfolio, so I'm going to talk about what I'm doing. We're going to take a look at the news, what it means for the company. I'm also going to be giving an updated valuation on Huntington Ingalls on what I think the intrinsic value of the company is now based on this information. Get some value out of this, please smash that thumbs up button. Really helps out the channel a lot. I personally appreciate it. If you like this kind of content, I encourage you to subscribe to my channel. So let's just jump right into this. So Huntington Ingalls, ticker symbol HII. So currently they're trading at $205. They were down almost 4% today. They end up being around 3% down after this news. So what is the news that came out? Let's go right over that. So Huntington Ingalls announced that they're acquiring Alion Science and Technology, enhancing its national security solutions portfolio. So Huntington Ingalls, just a background on them, they are a shipmaker, shipbuilder for the U.S. Navy. In fact, they're the only company that actually builds aircraft carriers for the U.S. Navy. They're only one of two companies that build submarines for the U.S. Navy. So massive moat for this company. And they're buying Alion to kind of give us, or trying to give them, a bigger variety of products that they can offer the U.S. Navy, because Alion does work with the U.S. Navy and potentially maybe even outside the U.S. government sector in general. So let's talk about Alion a little bit more. All right, so Alion enhances technical capabilities and positions Huntington Ingalls in high-growth, mission-critical security solutions, C5ISR, advanced military training, simulation, artificial intelligence, big data, and electronic warfare. Provides high-end solutions critical to multi-domain distributed operations while aligned with future U.S. Navy and Department of Defense modernization and readiness priorities. Accelerates technical solutions growth rate to 7 to 9% CAGR through 2024. So Huntington Ingalls was already doing this on the technical solution side, but it just gives them a bigger array of products within there. So Alion has about 3,000 employees itself, where Huntington Ingalls has around 44,000 employees. All right, so Huntington Ingalls is purchasing Alion for $1.65 billion in cash. Now they don't have that amount of money on their books. I think they have around, it was like 300 or 400 million in the last quarter. So they're actually going to be selling senior notes, and they're going to be tapping into the revolving credit line to be able to pay for this. So that's part of the reason why there's a small sell-off today. Another reason for that is it's going to impact negatively on the bottom line for Huntington Ingalls over the next year or two. So this article goes on to talk about that they're going to expect significant cash flow accretive in 2022 and GAAP EPS accretive in 2023. So what that means as far as EPS goes, they're going to actually see a negative impact 2021 and 2022 on the bottom line. However, they're going to see some positive cash flow from this transaction in 2022. So I went and I calculated how much it would, or how long it would take for Huntington Ingalls to actually get their money back on this acquisition. It would take them almost 9 years based on a 9% CAGR for this company. They also go on to talk about the transaction represents an enterprise value expected 2022 adjusted EBITDA multiple of approximately 12.2. So actually in that aspect, that's pretty cheap. So right now, Huntington Ingalls trading around like a 9 as far as enterprise value to EBITDA currently. So a 12 going out in the future, that's not too bad. But again, the issue is near term. So keep in mind that hedge funds, they're looking, 6 months out or less. Sometimes they'll look at a year out, but keep in mind that hedge fund managers, they're constantly compared to their peers, and if they're not doing well on a quarterly basis, they're going to get fired. So if it's going to take Huntington Ingalls, 18 months, 2 years, 3 years to see profitability from this transaction, there's going to be hedge fund managers that are going to be bailing out like we saw today. Now, as a long-term investor myself, I was planning to hold this until 2023. When I was looking at what happened with Huntington, keep in mind they had a rough 2020 with the whole Rona situation. They had attendance issues. I think 65%, only 65% of employees showed up in the second quarter of last year. These are massive ships that they're building. So ships that were supposed to be built in 2021 all of a sudden got pushed out to 2022. So a lot of hedge fund managers bailed at that time. Saw from 280 down to 140. It's kind of built up. Back then it's trading around 205. It got to about 230 recently. But we're getting into another situation now where hedge fund managers are going to look at this and say, oh man, this is going to take a long time to recover, because I had predicted at the end of 2021 or going into the first quarter of 2022 that Huntington was going to recover on an earnings per share basis. So I was going to see, double my money, because my cost base is around 165, 170. But now I think it's just going to take longer, and we'll get into valuation here in a second. But some great things about Alion: they do have $3 billion of backlog, and they also have about $5 billion in estimated contract value right now. We talked about Alion already has about 3,000 employees. Over 80% of the employees are maintaining security clearances. So that is, again, good news for Huntington. So currently the U.S. Navy represents about 1/3 of Alion's current annual revenue. So that gives them another big piece into the U.S. Navy, but 2/3 is outside the U.S. Navy. So I think that does give at least Huntington Ingalls some more diverse revenue outside U.S. government funds. All right, so Mike Petters, the CEO at Huntington, who I think is actually the best CEO I've ever done research on, this is what he has to say about the acquisition. We established a technical solutions division in 2016 with a vision and strategy focused on partnering with customers to solve their most pressing challenges, said Mike Petters. Today's announcement, coupled with our previous investment in leading-edge technologies such as cybersecurity and autonomous systems, reflect our commitment to stay on the cutting edge of critical high-growth national security solutions and generate significant long-term value for our shareholders. The combination of Alion and our technical solutions business represents a significant value creation opportunity that broadens our capabilities and customers' access in our targets market, said Andy Green, HII, Huntington Ingalls Executive Vice President and President of Technical Solutions. The experienced Alion team and the high complementary solutions and products they provide are consistent with the strategic vision we have articulated for the technical solutions business. And we are excited about the significant growth potential this combination represents. And they talk about some compelling strategic fits for the company: high complementary capabilities and customer access and priority growth markets aligned with future U.S. Navy and DoD customers, access to key contracts and leading edge technology development areas of cyber, data analytics, and electronic warfare. Acquisition creates $2.6 billion of revenue, products, and solutions business. So that is huge. So keep in mind, this company has about $8 to $9 billion of revenue. They're saying another 2.6 on that. So you're talking another 25% growth on the top line for Huntington for this acquisition alone. Strong projected financial opportunities. Transaction expected to be significant cash flow we've already kind of talked about in 2022, 2023, CAGR of 7 to 9%. Going out to 2024, I think it's going to be higher than that after 2024. They're expected Alion to have about $1.6 billion of contributed revenue in 2022 on the top line, and adjusted EBITDA of approximately $135 million. This enhances overall Huntington guidance by $200 million for 2022 out to 2024. So those are just kind of the big highlights there. And this transaction is planned to go into effect sometime in the second quarter of 2021. So now let's kind of jump in and kind of talk about my valuation for Huntington. All right, so here was my original valuation for Huntington Ingalls. This is my discounted free cash flow model, so you can kind of see how I calculated intrinsic value. Long story short, I'm basically coming up with a growth rate of 12% 1 to 3 years out, growth rate of 10% 4 to 6 years out, and a growth rate of 8% 7 to 10 years out. Keep in mind, over the last 3 years, Huntington has been around 11% growth rate for free cash flow. So I think those are pretty conservative numbers there. And what I'm calculating is an intrinsic value of $285 for this company, and currently they're trading at 204. So you're talking almost a 40% margin of safety for this company based on those assumptions. And I'm also requiring at least a 15% rate of return on this company. So let's talk about, or let's take a look at, updated discounted free cash flow based on this new information that we have. So what I did was I tried to project out over the next 10 years what the free cash flow would be based on this Alion acquisition. And I'm trying to be really conservative. So I'm saying next year, they're going to have, this column basically right here is what they're going to make as far as free cash flow, just Alion itself within the company. This other column here is what's going to contribute to Huntington Ingalls as a whole. So they already said basically next year that they're not going to have, or basically the first year they're not going to have any cash flow, attributable for Alion to Huntington. It's going to cost a lot of money to integrate A-line and other stuff that goes with that whole thing. I'm going to say in second year, only half the free cash flow is going to be attributable Huntington, and then it'll be full free cash flow after that. Now, as far as growth rates, I'm using a CAGR of 9% for the first 3 years. We got that from that article, 2024, and then I'm saying about a 12% growth rate on free cash flow wise going out after that. I think it could be more because they've already told us that's going to be around 25% increase to the top line. But again, I'm just being conservative. I'm just saying half of that's going to be free cash flow. So based on that information, I come with an intrinsic value of $296 now for Huntington Ingalls. Now, what's making a big driver for this that kind of pulled down the value is the debt issue, the whole debt dilemma here, because it's costing them $1.6 billion to pay for this company. So that's affecting this net debt number up here. So that's a 1.6. If they had the cash on hand just to pay for it, it'd be worth about $336 a share. But with that debt that they're going to have to pay back, I'm saying it's about $296. So you're talking about 45% margin of safety based on what we know now today. So, my thoughts about Huntington, I love this company. I love this CEO. 97% of their free cash flow historically has gone back to shareholders. They have a 2% dividend. They should easily still be able to pay for that dividend going forward. Their moat is just incredible. So it doesn't scare me. Now, I do think, over the next, couple months, even over the next 6 months, we could see a small sell-off on the stock. $204 is still a bargain if you are a long-term investor like I am. So again, this is a stock that you're probably going to have to hold out to 2023. I kind of compare this to Boeing. That's another one of my companies that I own that, stuff is just kind of going on right now. The bottom line doesn't look good. Free cash flow doesn't look all that great, at least from the Boeing side. Huntington still looks pretty decent. But it's just one of those things where you're not going to see the positive attributable effects to the stock price and the bottom line for a couple of years, unfortunately. But I still think this is a great company at a great value. So I'd love to hear from you guys. I mean, what do you think about this company? Do you think Phil Town's going to keep? Do you think he's going to buy more? My personal thought is he's just going to stay put. He likes this company a lot. I think his cost base is around 150, 160, similar to mine. So I think he's just going to hold on to it at this time. But I'd love to hear from you guys. Drop a comment down below. Like the video. Love you guys so much. Take care. God bless.